Good morning and welcome back to Good Returns. This is our monthly roundup, first week of the month, brand new month, March. Talk a little bit about the index returns, how the market's working out, and then we've got a few takeaways that will accompany the email, monthly roundup email that we sent out that we'll kind of deep dive into those. The email provides, again, sort of a 30,000 foot view, just like the weekly note does. And then we'll go into a little bit more detail on some of those things. But we'll get started here. I will let you take it's not in here, unfortunately, but we got to have the disclosure. I'll let you do it.
I think I have it up here. So this information is for educational informational purposes only, not to be taken as actionable investment advice. Always consult with a trusted advisor. And if you don't have one or would like to speak to us about becoming your trusted advisor, feel free to go to momentumwealth.us, free consultation, and we're more than happy to speak about your specific situation.
Excellent. Couldn't have said it better myself. And not even in the notes, straight from the dome. Good job.
Practice.
I'll let you stay. I'll keep you as a co-host. So in February, we had sort of the tale of two markets. S&P down about 1%. If you just read the headlines or saw the news, you might think, kind of a sleepy month, not much happened. But kind of if you dig down beneath the surface, kind of tells a different story. So what are we looking at with those?
Very interesting developments. The equal weight S&P, which over the years has increasingly become our North Star, is the equal weight S&P, has gained 3.5%, and the small caps were up 2%. That is a very large gap when you're looking at the return of indices over just a month period. We are seeing that rotation that we've spoken about play out. We were very early on with looking at the data in mid to late December and helping inform client allocations in January. The data, it's proving out to be more and more accurate, more and more right. The rotation is occurring, and we're seeing market-weighted indices really lag, the broader market, so to speak. That's very interesting. 3.5 to a -1. That's a big gap for a month. Now, will it persist? Will it grow? We'll have to see how everything plays out. But the rotation that we're witnessing daily does seem to reinforce that thesis that this is going to be a year of gains and earnings coming from many companies, not just 3, 4,
or 7.
7.
Yeah. It's really interesting to look at it. And it's one of the reasons we kind of talk to people about when people think of the market, they typically think of the S&P 500, which is a market cap weighted index. So you have it very heavily skewed, in this case, currently where we are at, to technology, because those are the companies that have seen the most amount of growth. So when you look at that, you could be fooled into thinking, the S&P is kind of the metric. And we always talk to people about, we like the equal weighted for that better, because it's a truer picture of kind of what's happening, including rotations and things like that. So when you see that equal weighted, I think it's a very good sign. When you see the equal weighted kind of outpacing the S&P 500, it just simply means that growth, everybody's participating in the growth. There's not 500 companies in the S&P anymore. It's a little bit more, but all of those companies are kind of spreading the growth out amongst themselves rather than, like you said, consolidated. So that's always a good sign. That's what you want to see in a good, healthy bull market. So it's encouraging to see that. Small caps was another part of it. I don't remember if you said that or not, but it was up 2%. So this is smaller companies, and this is another good sign where you've got growth coming in. This is another productive sign of a good bull market where the smaller companies are coming in and kind of making themselves known. The other thing that would happen in small caps is typically at the beginning of the year, that's what you see. So it could just be cyclical. We don't know. We look at the 10-year Treasury yield, though, and the movement there. Started the month a little higher, but it plummeted about 30 basis points to settle below 4%. So that is an interesting commentary, too.
I'm with you.
Are you?
My kid's on a field trip, and he was saying, the Apple Pay didn't go through, and he's mad messaging me. And I know that it did, so I had to send it again.
Putting out fires.
Yeah, so now I have to tell him not to spend it twice.
Well, I'll let you finish that. But the 10-year Treasury yield is something that we've looked at for quite a while. The yields usually drop.
What are we talking about? Just kidding.
We're at a podcast show. We're doing a show right now. Yeah, so yields drop when people expect the Fed to cut rates, but this month, as everybody knows, this kind of stood still. They kind of pushed back their estimates of rate cuts. So the yields didn't necessarily drop because of the Fed this time. They dropped because investors are kind of concerned. I don't know, maybe you use the term scared. They're kind of concerned. They're worried. There's a lot of uncertainty.
It's definitely an action-oriented move when you see that happen. So that it definitely could be uncertainty. It could be fear, or it also could just be the understanding that rates will be lower this time next year. So if we're going to go ahead and allocate to get the, say, a locked-in 10-year rate, risk-free at 4 points or whatever it may be, we need to go ahead and start buying. And of course, the incremental, as the buying continues, that pushes the rates down. So yeah, it can be a whole bunch of different elements.
Would you look at it as a flight to safety? Particularly paired with things like gold. We've had gold up really good in February.
Do you feel, I don't know, it depends on whether or not you think that government debt is safe. Now, from a statutory perspective, yes, it is safe.
Backed by the full faith and credit.
Yeah, there's lots of institutions. There's obviously the banks. There's lending that drives the stable coins that drive the consumption of government debt. But when it gets to be safe, I don't know. Do you think, getting 3.5% for the next 10 years is safe? Right. I mean, think of the last.
What's the alternative? I mean, I don't know. Well, that would depend on what the alternative is.
Well, let's say if you're looking at $1 million over 10 years and you approach your investments as being risk adverse. So you're going to buy a government bond that pays 3.5% or 4% over 10 years. So you have to hold it for 10 years, then you get your money back. Even if inflation is staying at between 2 to 3% over the next 10 years, when you get your money back, you'll get the 1,000,000. You'll get that back, but it will only be worth around $700,000 to $750,000 in purchasing power. So you're guaranteed to lose $250,000 in purchasing power. That to me is risk. There is risk in that. But when you think of it in nominal terms, and again, there are reasons why there's such a consumption of government debt, and it can and does and should play an important role in a diversified portfolio because of the nature and the cyclical nature of markets and how you are able to generate returns kind of in many different environments by using fixed income. But, when you really look at being safe, do the Russians, do they think it's safe to hold a bunch of government treasuries? No.
Well,
the Chinese definitely don't. They've reduced their holdings by, 60% over a decade. So, I don't know. It just depends on your definition of safe, I guess.
Well, historically speaking, that's sort of a flight to safety when you see people flocking to the treasury markets or gold particularly. But the funny thing about that is that gold has been, kind of the rock star of the past 12 to 18 months. But, the markets haven't done that bad themselves. So normally that's something that kind of would leave you scratching your head. Like, why is gold skyrocketing? But also the market's kind of going up as well.
Well, why did gold, we talked about this before the show started, why did gold sell off on Monday? We had a lot of global events occur within the last week. We had gold initially peak, again, trying to kiss that $5,500 an ounce. It's the second time now this year. And it sold off. So this is where you have to be careful when you're consuming financial news and financial data, and you're trying to use that to form a bias or come up with a thesis or a framework in the short term. You have to be very careful because on the one hand, for instance, the job numbers came in much better than expected in January. And that was the reason that the market was down for 2 days. Because the good job numbers, the Fed may not cut as much. Well, then today the job numbers came in softer than expected. And that's the reason that the market's down today. The job numbers, you see what I'm saying? So there's always...
Well, it's the same with earnings. I mean, we've had really good earnings reports. And sometimes when a company beats earnings, you'll still see them down. And after hours are down the next day. If they miss earnings, somehow they get a pop overnight or they get... So it's very confusing. And I think that goes into the uncertainty part of it, especially the valuations. as our esteemed Federal Reserve Chairman reminds us constantly, are being very high, especially with the valuations of the market being very high. It's that uncertainty. Like, how much higher can they keep going? Like,
Infinite.
is it?
They can go infinite. You don't pay attention to valuations, and we know this and have learned this.
Well,
over many
in
years.
a historical context, when you look, because that's what they're all saying. It's high in a historical context because you have like a 22x forward looking, like, historically, and we're somewhere above that at this point. I don't know if I could be completely wrong about that, but historically speaking is where they're talking about. And so this goes back to sentiment too, because you see like people getting scared, like, it's at the top. Are we at the top? Let's start moving out of the market. We've heard this over the years, this narrative, like, I'm going to start easing out of the market because I think it's really high.
I've heard that historically. So pick a date on the chart over the last decade and tell me when it was a good idea to ease out of the market.
Yeah, well, that's what I'm saying. Historically, that's a sign that it's not time to ease out of the market when you hear a lot of people talking about that.
Yeah, things are changing, and this is I was listening the other day. I think it was Mark Yusko, who runs a venture capital fund. He's Canadian, but I believe he's now in the U.S. And he's very, very successful at what he does. VC funds generally raise money through accredited investors for a 10-year lockup, and they make long-term investments generally in private equity of firms. Sometimes they'll do things that can be publicly bought, be it maybe Bitcoin or other real estate, other things of that nature, but it's a lockup. And he's done very well, very well. And he was going over this assumption of people, and even with gold, when you look at price or you look at valuation, and people just don't realize that the price does not equal value, and the valuation does not. It is not the market properly pricing in the true future value of a company either. So a price of a stock, let's say.
Do we get an illustration?
It's time to bring out the Coke Zero anyway, so we might as well.
My goodness, they're not even a sponsor. Why are you?
Could we get Coke as a sponsor? That is the question. Let's look at the price of Coca-Cola stock today. There we go. We are looking at $200 a share. So that share price, as I in real time, 201.38, that is the value of the last share that traded between one person and another person. That is it.
Right.
So whoever that settles to is determining the price. And then the market cap or the value of Coke is also determined by that price. So what it's looking at is Joe and Bob decided to sell their share to each other, and at $200. That last transaction times how many outstanding shares equals the market cap of Coke. And so it's really, the price action is driven in the short term, definitely by the marginal transactions, but the inherent value of Coke is not really borne out until many, many years in the future. Its staying power, its ability to dominate the market, to create refreshing. Is that the phrase? It's refreshing.
It's basically the Eugene Fama and the efficient market hypothesis, which is that the market knows what the market knows, and the price is the price because that's what the market has said.
Yeah, and in the long run, it's right, 100% of the time. In the short run, however, it's not always right, because it's just that day how many people sold their shares of Aflac.
Well, I wonder, because of all the algorithmic trading that's happening now, I wonder how that affects it too in the shorter term. Obviously not in the longer term, but if you have, sort of stop loss is set or something and it falls and it just keeps hammering that, I mean, is that indicative of the market being efficient as well?
No, absolutely not. It's an inefficiency of the market, and capturing the gap between what a company can be valued at based on what they're currently doing and what it's trading at today has always been a big moneymaker for large institutional players in Wall Street. But now with social media, algorithmic trading, the advent of artificial intelligence, how all this blends together, they are literally able in real time to capitalize on people's emotional responses from what's happening in the news to what they're willing to do with their brokerage account. And they have all the data, and the house is going to win. They're stacked against you. So that's why you can see things that do seem crazy and irrational, and then you'll have headlines that reinforce it, and it just continues to happen. For instance, you have the software apocalypse that's occurring, but not all software is created equally, but every single software stock got utterly hammered. Well, because once the algorithms kick in, and they already know too, because they buy this information from the broker-dealers, they know how many people are sitting on highly appreciated shares of ServiceNow or Salesforce, or you name it, NVIDIA. They know.
Yeah.
They know that we've got 10,000 retail investors that are sitting on over 1,000% gains at Robinhood on this. So we know the likelihood of getting them to sell is probably pretty high, because if you've already held something from 100 to 1,000 and it starts going to 800, you're probably going to sell. And so they can force that to happen in the short run, and it creates a lot of the cyclical buying opportunities that present themselves in the market. And that is not the real value of those companies. It's just simply not. When you see, when you see a company that just can just get hammered after an earnings call, even though they beat everything, beat expectations, I refuse to believe for a second that all the shareholders that held on Tuesday when it was $500 a share are going to sell at the open at $300 a share because their company made more money than they thought. It's just too much money. I can't handle it. It's just, I have to sell because they're making too much money. A lot of it's algorithmic trading. And that's why you have to be very careful about using short-term events to drive your pattern of decision-making. Just like what happened over the last week. You'd have thought gold would have broke $5,500 an ounce. It sold off. So if you bought gold Monday, you're already down 8-9% within just the past few days, and it's counterintuitive. It's all very interesting, and we're probably getting off track a little bit, but I
think it's okay.
I guess the moral of the story is that
down 3.6 on the week, gold.
3.6 on the week. And so I think maybe it was Sunday, if you would have bought futures markets, when it was at the highest over the weekend.
Yeah, I mean, there was a big drop at the beginning of the week.
So, but we do know that in the long run, the market environment for gold is still very positive, still a very positive outlook. But you just have to be careful, because things are not always as they seem, and that's why it's very important to have a very long-term perspective on your retirement planning and your retirement income strategy. And you can't let short-term things really drive decision-making, because you may be thinking that you're doing the right thing. Just right now, there's a lot of talk about the price of oil. You may be thinking, oh, wouldn't it be a good time? Well, what happens if in a month all of this is settled and now we're looking at a free-flowing oil market in one of the largest oil-producing regions on planet Earth? That's going to be more oil. What happens when you have an increase in supply? Price goes down.
Yeah, that's one of the uncertainty. That's one of the parts of uncertainty about this whole thing, about how long it's going to last. And you have there's some news reports the administration is saying it could last till like September, October. I mean, it's anybody's guess as to what's going to happen. But we can talk about that. I think that we don't want to beat a dead horse necessarily, but moving into sort of the next segment, takeaway is we talk about the mega cap tech dominance taking a breather. NASDAQ dropped 3%. Growth stocks rose nearly 5%. So
no value 5.
Oh, value. That's right. Value beat growth.
Another gap, another huge gap that we haven't seen since 2022. Big gap.
Yeah, you're right. That does say value, doesn't it? Yep. I misread. My apologies. So we're not going to beat a dead horse about it, but there's a rotation taking place. Yeah. That's the end of the story. That's what we're seeing, and we sort of saw that coming on the horizon at the beginning of the year, and it's sort of playing out.
Yeah.
Now, is that going to be all year? To your point, I don't know.
Yeah.
So we'll take it as it comes to us. But looking at the bond rally, Treasury bonds rallied. It wasn't about the Fed. We kind of talked about that as well. They're willing to accept lower yields just to have the safety of the U.S. government guarantee while the market feels shaky and uncertain. And there's a number of reasons for that. We talked about the conflict that started over the weekend. You talk about heightened valuations, all this kind of stuff that's the news, the talking heads are coming at you with,
And the end result,
headline.
the end result, the positive nature and kind of the self-rebalancing aspect of when we have a big rally in bonds is you do have that yield curve is steepening. It's only the 1 month is now higher than an older maturity. So we're almost to an actual steep, which we need a steep. That's a healthy thing to have.
It's been like that for a while.
Well, we've been. I think
short-term treasuries have been paying.
Yeah, short term is high, but now I think it's like it goes one. I'll actually tell you right here because I had it.
Well, I mean, the benefit of it is it's higher interest, either in these treasury yields or even in high yield savings accounts. I mean, you should be able to find a high yield savings account that's paying you 3+% on your savings, your cash.
And if you're not, reach out to us. We're more than happy to help you with that.
Yeah, I mean, there are avenues to get that, which is nice, but it's probably going to change over the course of the year, especially with a new Federal Reserve chairman coming in. Jay Powell's term is going to end. We have somebody else coming in who is going to be, by all accounts, working very closely with Besant at the Treasury to sort of fix the debt issue. That's a whole nother conversation for a whole other show, but it's interesting how they are potentially going to be able to do that. And I would assume that that's going to coincide with some rate cuts.
Yeah, it'll get that 3 month. Once the 3 month breaks below 3.5, now we have a steepening of the yield curve, which generally is a good signal for every aspect of the market. That is obviously going to mean that your high yield rates that your savings are going to go down after peaking in 23, maybe.
Yeah.
Middle of 23. So they are going to be trending down. And it creates opportunities. And again, we're generally speaking, once that yield curve steepens, it's just another tailwind for a bull market in general. So we talked about treasuries, and we did mention already about gold.
Yep.
Now, February was a great month from gold after getting sold off in January. And this kind of goes into what I was talking about. It generally is seen as the ultimate crisis barometer, which was interesting to see it sell off at the open on Monday. That could be more of a technical element, or it could tell you that there's less worry under the surface than what you would think. I mean, it could go either way. And generally, you'll have people buying gold for currencies, worried about the stability of currencies and geopolitical friction. And then we also have central bank buying. So that's been a big driver in the gold market over the last few years, is you increasingly have other large countries that are diversifying their holdings, maybe away from the euro, away from the dollar, or their debt instruments, the euro debt instruments or the dollar debt instruments, into increasing their gold stockpiles. And that trend, I don't think that trend slows down. I think that we see that continue, but that has also been a good support for the gold market since we've really been in the gold bull market going back to 23.
Yeah, I don't think gold sold off in January.
Let's see.
Yeah, no, it was up 12%.
Let's see.
So we've got 2 really strong months for gold. Yeah, we're up 22% since in January and February.
Well, okay, this is where, so we had end of January, we peak, sold off.
Yep.
February. So on a monthly return basis, that's correct. But if you had bought on January the 28th, you would be down. You'd be down 6%. So yeah, January 1 to January 30 up, February 1 because it's sold off at the open. So from February
down
1,
5.75%.
Yeah. So if you'd have bought peak to trough, but if you opened and closed like futures contracts, you made money both months for sure. But the uptrend is still intact. That's really what we're saying when we're looking at this. So that you can read signals from that. You can start to gain confidence in a bias or a framework for the market when gold is still kind of holding strong. Silver, another animal. Silver's acting more like a speculative asset, really since November. But gold still
starting to get a lot of questions about silver. We had historically gotten questions about gold. Now we're getting questions about silver. So, it's interesting.
Well, let's take a look at that manufacturing surprise.
Yeah, the ISM Manufacturing Index
Yeah.
hit 52.4, breaking a pretty long slump, a couple of years. What does it mean?
Well, it's really it shows Main Street versus Wall Street. So it kind of shows real world productivity. And what I mean by that is not that, there's not productivity elsewhere, but very simply put, the goods part, not the services part, is expanding. And it's expanding for the first time in many, many years. I don't have the exact year. I want to think since before, if you cancel out the COVID noise, shutdown recovery, it's before that we were in expansion mode. So factories are getting busy. There's a lot of surge of new orders. We saw the PPI index come in hotter than expected. That's kind of reinforcing that perspective. A lot of buying, even though the financial side of the things, the stock market's kind of fretting over interest rates and are we going to get a lot? Are we going to get a little? When, cuts coming? There is an expansion. There is an expansion occurring with factories. That's a good sign because after you hit expansion, you can go back and chart this. Generally good things come. Money supply expands, lending expands, stock market gains can be significant. So it's a good thing to see. And a lot of businesses were waiting for rates to drop to buy new machinery and, to maintain or increase productivity. Now we can see they're no longer waiting. They're actually doing it. So maybe interest rates, that could be a signal for the Fed too. The interest rates are getting low enough for expansion, and that could help inform how much they cut this year as well.
Yeah, all interesting context. We already talked about it too, but the kind of broadening of sector leadership, rotation, look at international stocks specifically. You've got them up 5%, and year to date, I think, let's see what they are. Year to date, you're up. If you have like an EAFE index, you're up 3% compared to the S&P, which is down. So I think the theme we're looking at now, and again, we're only 3 months into the year, but the theme seems to be kind of rotation and broadening, and these are all good things. These are all things that are positive that you want to see moving away from just a select few group of people. Now, if you just are holding those select stocks, those 7 stocks, and you've held them for the past few years, you've done very well. Mm-hmm. And now it's time to look at maybe coming up with a different plan, maybe rotating out of those, maybe going into a different sector, maybe looking at something else if we are going to continue to see this pattern of rotating away from it.
Yeah, because we're really at an inflection point, and it's not like a singular moment in time. The inflection point's occurring over the last 12 months and now probably over the next 36 months, where will the big tech winners be able to take advantage of this exponential growth that we're in with artificial intelligence, or will they be disrupted and disintermediated? That's the question that is yet to be answered, and that determines whether or not the market-weighted approach will still continue to win, or will we see like we saw coming out of the tech boom in the 90s, where you had significant disruption and disintermediation to where the biggest players in the market were replaced by smaller, more innovative players that then became the dominant players who is the people we're looking at now. Oh, I couldn't finish that.
Yeah,
sentence.
the only thing I would say to that is that seems to be the case where you do have smaller companies coming in and providing this value, but they almost always get snapped up by the larger companies. And especially now, you have a small AI firm that maybe has a really good niche on something they've done really well, let's say voice recognition or, translation or something like that. And one of the Apples or Amazons or Googles or whatever will snap them up and just fold them into the company. And so that's going to be an interesting thing to see. I mean, I don't think that I don't think we're saying that it's the end of the road for tech growth companies. I mean, I think that they will figure out a way to pivot and continue to have growth.
In all likelihood, if I had to bet, I would bet in all likelihood in 10 years, they're much bigger than they are now.
Yeah.
But it's just, when you're looking at, and we know this, if you're looking at a small company, and I say small, I'm talking about a small publicly traded company, say it's worth $10 billion, the amount of innovation and profit that can come from that company adopting AI is a multiple of what probably some of the larger tech firms that have been slowly innovating and maintaining their leadership over years, because you can go from being a $10 billion company to being a $100 billion company in a year very easily if you do the right things and you lean into this technology to save money on operating cost, OPEX. So there's still there. That's why I just, as a percentage return, while I do think the big tech players are going to be worth a lot more in a decade than they are now, as a multiple return, it would not surprise me to see, 50, 100, 150 smaller companies that become $500 billion or $1 trillion companies because of AI. I think that's
scrappier and leaner.
Yeah.
Yeah, I mean, that's a possibility. It's going to be interesting to see. I think we're still in the wild, wild west as far as that's concerned, to figure out what you can do, how much freedom and flexibility it gives you to compete against people that are bigger in your space. Time will tell. I mean, it's an interesting conversation to have. It's an interesting
We know a lot about
framework.
Competing with people that are...
Do we?
Yeah, I mean, we do. When you're a smaller firm that's growing, and you have to be more creative, and you have to be really intently focused on solving people's real world problems. And that's a good thing for the marketplace, and it's a good thing for businesses that embrace that and do it. And they will grow and disintermediate kind of the players that are kind of sitting on their laurels. Whatever a laurel is. I don't know. Do you know
Is it a tree? No, I don't know what a laurel is.
Maybe something to do with a horse.
Let's ask. What is a laurel? Drum roll. A tree, an evergreen tree. The Mediterranean region.
You have to say about the phrasing. I don't think that...
All right, well, let's...
What does it mean for somebody to sit on their laurels?
This is so off.
I don't think it means somebody to sit on a tree.
What is sitting on your laurels?
Yeah, I think it's something to do with a horse.
Spelled it. All right, we're using AIs. I mean, it doesn't... Resting on your laurels, I think, is the phrase. Originates from the practice of crowning victors in ancient Greece with laurel wreaths, which symbolize victory and achievement.
So it has to do with the tree.
I told you.
So resting on your prior accomplishments. Wow, that's
what a way to end the podcast.
Powerful way to end the podcast. And just keep in mind, this is, what we see as a great start to the year. We have said over and over again that our wonderful retirees, the generation that is nearing or beginning to enter into, maybe already in retirement, the timing could not be better to make sure you're getting your income plan and your retirement plan right. There's so many positive things about the future that are really going to allow you to live your best life in retirement. And we'd love to be a part of it. So feel free to go to momentumwealth.us. If you know somebody that could benefit from listening to this, feel free to share. Always feel free to comment. And we have another week behind us, 2 months behind us. We're entering the third month pretty soon. We'll be at the end of the year. It's going to fly by.
Don't say that. Needs to go by a little bit slower. You can't stop it though.
No, you can't.
All right. Well, that was a good show. We will see you guys next week. Same time, same place. Have a great week.
Yeah. Take care.